G'day, it's Sam here from Protrader. Frank and Richard have asked me to do a weekly webinar every Wednesday night, so I'm going to start doing it every Wednesday night. I'll try and bring it out by 6 p.m. Western Australian time. I'll do my best to be consistent and regular with that. I have a young family and a few things on my plate, so apologies if I'm late sometimes, but I'll do my best. I've been a member, a bit of background, I've been a member of Protrader since early 2005, and I've been trading since early 2003. I went through, the first 2 years or 3 years or whatever, the same hiccups that most people encounter. When I met Frank in 2005, he really helped, with the way I look at the market. I learned about Davis and about looking at trends and looking for stocks that are going up and cutting losses and letting winners run and all that sort of stuff. And I owe a lot to Frank, and I'm a big fan of his, and I think he's created a wonderful software system that really, if you put the work in, it doesn't do the work, doesn't do everything for you, but it puts amazing stocks out there, and all you have to do is have the discipline to take action and follow a plan. And if you can do that on a consistent basis, week in, week out, month in, month out, you're going to get very, very good at it, and you're going to make money, and you're going to be in charge of your finances, and you're going to have the chance to live on your terms, to not have a boss, to work for yourself if that's what you want, or if the goal is to manage your own super fund, you're going to be able to do that and have so much more confidence than you would, in my opinion, leaving your money with a fund manager. If there's during the GFC, when everyone was lost half their super, the good investors out there didn't, and I think one of the wonderful things about the Protrader system is that, and you can take charge of your own finances, and you can take responsibility, and there's no excuses. If you put the work in and you follow a system, anyone can do it. And so what the goal is today is to go over what I look for with stocks. So I trade a few different things, but obviously, I'm just going to talk about stock trading. I have two trading accounts when it comes to stocks. One is an incredibly long-term account, which I will go into in another time. In that account, I invest a lot for the very long term, and mainly with ETFs. But my main focus is short to medium term trading. So days to months to sometimes a year or two. I'll hold something if it's trending really well. And that's where my main focus is. And so I think the purpose of today is just to go over examples of recent setups that have gone okay or not gone okay, and so that I think that's the best way to show people what I'm looking for in a stock and my system. And then in other weeks I will go into a lot more detail on current setups, and I will touch on current setups today as well at the end if I have time. But the purpose of today will just be to really show people the system and how I view things. And so, all right. So to get started, first of all, every chart I've got, I always have the same moving averages on. And moving averages to me, they're not just random lagging indicator lines across a chart. They have a lot of meaning behind them. There's a lot of psychology behind every moving average, and it's not just crazy chartists that look at these things. If you do a lot of digging and research with fund managers, and some massive fund managers in the US and even in Aussie, these guys, a lot of them look at moving averages. It's a pretty widely accepted thing. And so I'll just go through them. The black moving average is 200-day moving average, and the 200-day moving average is the most famous moving average that people look at, from Bitcoin to gold, oil to stocks to indexes to everything. And there was the famous hedge fund manager called Protrader Jones, who's a market wizard, who's interviewed in Jack Swagger's book. I think it was his first book. And he was famous for saying that bad things happen below the 200-day moving average. And my experience is that's true. Bad things can happen at any time in the stock market, but holding a stock when it's below its 200-day moving average, to me, is just I don't feel nice about that. And I know there's a lot of traders out there who will trade who just do not look at moving averages, and that's great. There's no right way to do things. There's what works for you, and for me, keeping my buys to trend in stocks above their 200-day moving average really works for me. And but it's each for their own, and it's up for us all to learn a lot and do our own back testing and then trade and see and see what works for you, and just become a student, and you'll make your own mind up and all that stuff. And so for me, you'll see every single setup is the same. It's always above its 200-day. The next moving average is the 100-day moving average. It's probably the least important of these three. I like to just see it trending up. There's a lot of stocks that will pull back to their 100-day moving average quite often, and during pullbacks, let's just get all this stuff off the chart. During pullbacks, the 100-day moving average tends to act as a support line. So Workday is a leading software stock in the States. It's been going up for forever. Trading breakouts on this thing is super hard. The institutions and managed funds and whatnot, they like to buy this stock on pullbacks, and it's very choppy. And so, but you see, it'll pull back to its 50-day line here and its 100-day line, and then bounce, and it will just does this, forever. Okay, and so that's why the moving averages, they're not just random lines. There's a lot of smart money out there that hedge funds, they don't like to buy breakouts, because buying a breakout, for them, it's quite a risky thing to do, because if you have $20 million and you're trying to move it into a stock, there are a lot of people competing for that stock during a breakout. There's retail traders, investors buying breakouts. There's some fund managers that buying breakouts. There's a lot of people competing for that stock. Whereas during a market correction and a pullback to its 50-day or 100-day line, there's a lot of scared people, and then so you get a transfer from weak holders to strong holders, of around these 50 and 100-day lines. And so that's why I look at these lines closely. I like to see stocks bouncing off them and keeping to them. So the blue line is the 50-day moving average line. It's probably the second most important behind the 200-day. Really strong stocks pull back to the 50-day and tend not to go much below the 50-day. And what trend's really strong if it just tags that 50-day and stays above it. And the All Ords has done that. Like if you look at the last two corrections, it's just tagged its 50-day and bounced up. And so that's a good sign for the trend of the All Ords. It's a good sign that the trend's strong. Okay. Now the next one is the 21-day line. So the 21-day moving average is, I look at the 50-day a lot more, but the 21-day tends to, if you have a stock that is trending really, really strongly, such as Shopify, which is a leading e-commerce website business, so online stores and stuff, they've had massive earnings growth over the last few years. Broke out of this base back here in April, and it's been trending up. And so this is just a good example of a stock that obeys its 21-day moving average line. And when you have a leading stock such as Shopify that all the institutions and managed funds love, break out of a base, run up, pull back, and just bounce off its 21-day line, and then break out, it tends to be a breakout that you can trust more than a really deep pullback. And even if you're a super short-term trader, you can trade these breakouts after but it's just a sign of strength, okay? And a lot of people use them for stop losses. I don't use a moving average for a stop loss. Very rarely. I used to, but I find it easy to use other ways, which I'll go into another time. But so there are moving averages. I have them on every chart, and I want them all to be in sync. So I want them all trending up, and I want the price to be above them. I would never say I do break that rule maybe twice a year. I will buy a stock that's below its moving averages, and the setup has to be absolutely brilliant. There's so many setups out there for me, trading even the Aussie market, but because I trade the US too, that I just don't feel the need to buy stocks that are below moving averages. The exception is in a bear market, and bear markets are a completely different beast, and you have incredibly quick rallies in a bear market, and obviously then it goes back down quite quickly too, and there's a whole different way of trading in a bear market, but we're not in a bear market now, and that's for another time. So okay, so that's that. Now that's the moving average discussed. So the next thing I do is the setups I look for. I'm mainly looking for tight setups, and I'm looking for volatility and volume contraction during a tight pattern, and that's probably the best way to describe it. I'm really after stocks ideally that are under-owned and exciting and new and growing quickly, and I love RPOs. I love exciting new stocks. In America, there's this recent IPO called Beyond Meat, which they make fake meat, which I personally, think is going to be massive, but we won't go into that. I'll talk forever about it, but it's just one of these stocks that it's a recent IPO. Everyone's no one really owns it yet, but it has the potential to change the world nearly. They're creating fake meat now that people can't really tell the difference between this meat and normal meat, and that has massive implications for society. And so and the stock acts in a way that you'd expect a stock like that to act. Excuse me about that. It goes up. It goes up violently and has violent breakouts and is very volatile. So when I'm looking for stocks, ideally I'm looking for exciting stocks and high growth stocks that can move. I want a stock that can literally double, quickly within months, if possible. I don't want a stock that I'm going to have to sit in for ages for it to go up 5%. It's just not for me. Okay, so I'm just going to run through some recent setups. So Funko is an American stock on the NASDAQ that had a massive run last year, and it's been basing since then. Okay, just been going sideways. And so recently it formed this really tight range, and it broke up to this range. So I'm looking for these tight ranges. Funko is a cool company that make little dolls of it sounds random, but they've actually got some pretty cool growth and sales stuff. And it's it formed this tight little range. The volume during this pattern, it was incredibly low, and then it broke out in big volume. And so the way I do this is I will buy this breakout, and my stop loss will literally go below the low of the day of the breakout. So it's my stop loss is so tight that I'm pretty much saying I either get a clean breakout or I'm going to take a tiny loss, and the tiny loss is not going to hurt me at all. Whereas if I get a clean breakout, I'm going to have a really good run. Okay. And so this little box here is where I calculate my risk. So let's say this stock breaks out, and then the next day some report comes out and it gaps down. And so it might gap down here, it might gap down here, but I just hope that this is how I calculate my risk anyway. You can't ever do it scientifically, but so I will assume that I will get out of this stock around about here, and in that case I will lose about 1, maybe sometimes 1.2, 1.3% of my entire account, but I try and keep it about 1%. But if this breaks out and then goes back below the low of this day, I'm going to lose like heaps less than 1% of my account. It's going to be such a small loss that I'm not really going to, I'm just not going to feel it. I tend not to feel many losses these days, but I'm certainly not going to feel this loss if it goes below that candle. I'm just going to put it in the books and move on to the next trade. It's not going to get in my mind and wreak havoc like it can do when you take big losses. And so that's the way my mind works. I don't enjoy it, but I'm totally cool with taking many small losses, because I did this study where I went back through hundreds and hundreds and hundreds, literally probably well over 1,000 trades that I'd done. And I found that not all, but like literally, it was crazy high. I was like 90% of my winners, my big winners, I was ahead from the gun. It broke out and it went, and then everyone went back. I was never showing a loss for those ones. Okay, and so that's what I've learned over the years, that the good trades just break out and go. And so a breakout, to me, it's a bit like a party. Like if you rock up to a party, no one's there, you're going to leave. It's just you rock up and think it's a bit dodgy, a bit boring, let's go. And so it's the same with the breakout. Like, either a lot of people rock up and the stock goes up quickly, or they don't. And if people don't rock up, then the volume's low and this thing's all lethargic, and I just bail. Whereas if I rock up and I get a nice breakout, then that's where the money's made. And I guess for some slow moving stocks, like the other day I traded Medibank, some slow moving insurance stock, and I gave that more leeway because the personality of that stock it's super slow and boring. But for a stock like Funko, you're expecting it to break out and move, and if it doesn't, maybe that's a warning sign, and it's time to take a small loss. So moving on, let's go to Silver Lake. So Silver Lake is an Aussie gold stock, and so I'm pretty sure a lot of members have probably got in this. Gold's booming, gold's trending up at the moment, and Silver Lake's a gold stock. And so, one of the main things I do is, if you have iron ore or gold or copper or whatever trending up and making new highs, then you've got to take signals in those gold or copper or iron ore stocks, because that signal is so much more valid. And so Silver Lake formed a really nice base, really nice volume on the formation of the base, and nice volume spikes, really small volume during the base. And so, especially along the bottoms here, when we're coming down, you look at this big down day here on the 7th of May, I mean, that was done on really, really little volume for this stock, which is what you want to see. It's not that many people that are just bailing out of this thing. On balance volume is strong, it's going up. We have, big volume on the breakout. And here's another example of stock, like it didn't come back. The real winners don't come back, and you're just ahead from where go. And so this is a stock that you want to hang on to, because it breaks out on big volume, it doesn't come back and show you a loss at any stage, and it just goes. So even with that, so my stop loss would be, below the day of the breakout. It wouldn't be under here, under here, under here. To me, that's like that works for some people, and that's awesome. But for me, it's just I hate giving away that much. I don't want to lose that much, and to be if I'm going to lose, it's like a race. Like if you're going to lose a race, it's better lose by a meter than 100 meters. And if I'm going to lose money, I prefer to lose a little bit of money than a lot of money. And that's just the way my mind works. And so that's what I do. So with this one, I sold half at the depth of the pattern. Felt like an idiot because it just keeps storming up, and so I think I sold 60%. I've got 40% or just under 40% left of that, and I'm just going to ride it. I'll try and draw a trend line on that, and try and ride it up. But I'm just going to be trying to be patient with that. I have a stop loss, I think, below the low of this candle. I'm just hoping it's going to chop around here and then go up more. But we'll wait and see. There's a chance it'll come down and that rest will get stopped out, but that's life. Okay, so moving on, let's go to another one that I'm sure a few people have been trading, because Frank put this up, I think, on the Protrader Facebook page a few times, and I posted it as well once. And what I'm really looking at is this base here. Like, first of all, this is a recent IPO. This stock's new. Not many people own it. Not many people have heard about it. Therefore, it has a lot of potential to go up. It's an exciting stock that moves quickly, and it's exactly what I look for. These recent IPOs are exciting. And so this formed this IPO base, I call it, just a recent IPO that had a base, and the volume dropped off during its base, and then it broke up. And it didn't break up with big volume, but it never showed me a loss, and it just went, right? And so the depth of this pattern here, I sold half about there, and then I felt like an idiot again because it kept going up. And so, I'm out of this thing now. I'm not very good at holding stocks as they plummet, and it's my weakness, I guess. But when a stock forms, this is a very short-term signal, but has two blow-off candles in a row with big wicks to the upside. On this one's pretty big volume this day. It's just a sign that people are going to bail. If there's so many traders out there who have been in with this thing since this breakout, or even this breakout, or even back here, who are seeing these two blow-off candles with high wicks to the upside and thinking, well, let's put our stop loss below the low of this candle, and all their stop losses get hit, and boom, it just goes down a lot. And it's probably going to recover and make new highs, and if it forms a nice base here, I'll buy that new high. But for now, I'm out of there. I didn't get the best fill on that because there were so many stop losses there, but I think I got filled, there or something, but bit of slippage, but that's the way it goes. Time will tell whether or not that's a good exit, but for now, that's the way it is. And so let's move on. AGH is another Aussie stock that has formed just tight base after tight base. Moving averages lined up. This tight base, actually failed this one. So I think I lost that trade, but this tight base worked. This tight base worked. This is just an example of tight bases. And, if you just look, if you get your, system up and have a look at the volume of these bases, it's very, very low volume during the bases. And that's key. Like, you need volume dry up right before the breakout. So if we go back to the UWL chart, this candle here on the 13th of June, the volume was super low, $756,000 worth done. It's pretty low. The day before that was 1.7 mil, and this candle hardly moved, and it's just a lovely volume contraction right before breakout, and then we have breakout. So I'm really looking for candles like that right before breakout. I don't really like something that's down here and then just breaks out. I'd like it to just ideally, and you don't always get what you want, but ideally like a little tiny bar like that sitting right below resistance on tiny volume with tiny price movement right before breakout. Okay, so moving on to a stock that I'm sure everyone knows. So A2M is obviously a leading stock that has been going up for a long time. If we look at this chart on a monthly, obviously people have made riches by investing in this stock. But going to a trading perspective, let's just get back to that. So this guy formed a nice base here, all right. I didn't trade it because it was just the 200-day was still sloping down, and it's just not, a bit too early for me. It broke out of this base, should have, very nice buy for, I'm sure a lot of Protrader members got that. And then it formed another little base here, and this is the base that I would jump in on, and I did jump in on this guy. So he, forms a really tight base, volume drops off, and then breaks out and ends up and away. And another week I'll talk about how I at least try and deal with these intraday whipping around, but there's no easy way and there's no right way or wrong way to do it, but it's tricky. But yeah, so a tight base, another tight base here. I tend to watch leading stocks like this closely. I have a watch list and I look at them every day because they just set up time and time again. Okay, so let's just quickly move on because time's getting along. AGYS is a NASDAQ stock that I just, is an example of a setup I look for where this stock had a surprise earnings announcement on these 2 days back here, okay, and went up with huge volume and there's just urgency here. People are just piling into this stock because the news is so good and it was unexpected, and that's, everyone just went for it, okay, and then the next 6 days it just chilled out and went sideways. The volume wasn't anything spectacular, it just consolidated and then it broke up. And so the reason I like this is I like seeing desperation and people just having to own this stock. And this is some decent money going through. There's probably some managed funds and pile into that. And then it stays within the top half of this candle, which I love. So these are all pretty much inside bars, inside this big candle. And then, another thing I look at, especially, I do it for Aussie stocks now too, but I look at Twitter, and I look to see how many people are tweeting about a setup, and if there's a lot of people tweeting about a setup, I walk away from it and I don't enter that thing. And especially if there's certain people, I hate social media and Twitter, and I'm not a fan really at all. I don't really ever chat, on Twitter or anything, or but I like it because it can help you make money, especially if there's people who are bad traders. I don't know another way to put that, but there's certain people out there who you just probably know just like to lose money, and they're just posting things all the time, and you get to realize after a while who they are. And when I look at Twitter and just see hundreds of people tweeting about a certain setup and how good it looks, the opposite is usually true, and it's usually too good to be true, that setup. Okay, it might be obvious and a nice clear breakout, but if everyone's looking at it, it can't be that good. And so what I like to see is, and there's always is next to no one looking at a setup that I'm looking at, or if I get on to social media or Twitter or whatever, and there's a few people looking at it, but I know that they've been trading that they're good, or I know that I kind of trust their views, then that might not persuade me. But if there's hundreds and hundreds of people looking at something, and most of them are just teenagers just tweeting out, then you got to, usually that ends badly, and usually you get nasty false breakouts with that. Classic example is Workday the other day. This is a US stock. This Twitter was just going nuts for this thing, before it broke out. There was all these people saying, "Oh, look at this, double top's about to break out of this new base," and and it's just an outright false breakout. So, I think I like to use social media as a contrarian indicator. I think it's a good example of the damage that noise does to our trading. You really want to block noise out if you can, and you need to figure out what is good noise and what's bad noise, because they're clearly different things. And anyway, that's a bit of random Twitter stuff. So Erie is another American stock, and sorry for keep showing, if most people listen to this Aussie, but a chart to chart and a setup's a setup, and these appear on all markets. And so Erie is a stock that has been trending up for forever. And what I like about this setup is this bar here. All the bars are inside this bar. It's like a big inside bar happening. There's like 16 inside bars here. And what I mean by inside bar is that all these bars are inside this big bar. Okay, and so all these inside bars pretty much stay in the top half of this inside bar, which is just a sign of incredible strength. And then we have rising bottom, so we have a descending triangle as well. So I like inside bars full stop, and I like ascending triangles full stop, and I have both of them in one. And I have pretty small volume during the pattern, then I have big volume towards the end of the pattern, then I have a breakout. And this never showed me a loss. It went up, it hit its profit target, which is the depth of the ascending triangle, pretty quickly. There's no stresses involved. It's a lovely way to trade, just by following clear patterns. Okay. Now, there's a new scan function on. It's a good time to quickly mention this. Frank was very nice and agreed to put in a new Davis box scanning tool. The only difference between the Sam's Davis box and this Davis box here, the traditional Davis box, is that the Sam's Davis box finds inside bars, Davis boxes, whereas the normal one doesn't. It used to, I think, many years ago, but I think the system changed and it stopped doing it. And so I like the inside bars a lot, and that's the only difference between that. But the Sam's Davis box thing here finds all the other normal Davis boxes still. It just also finds inside bar ones. So that's the only difference there. Okay, so moving on, there's a few others just quickly. We're running out of time, so it's nearly half an hour now, so I'll leave it to next week soon. But A&O is a stock that's probably the best performing stock in the market this year. It's going up and up and up and up and up. Now, I won't go through the bases back here because it's kind of hard to see it's gone up so much. But there's a few things about the stock. First of all, there's a lot of people that miss the time move, and they're probably feeling psychologically a bit hurt by that they missed such a huge move, and they're thinking, oh look, I could have bought this thing at 90 cents, I can't possibly buy it at $5. And then there's other people who did buy it down here, got in at $1 and out at $2, and they're thinking to themselves, gee, I can't buy it at $5. It's impossible because I had it at $1 and I sold it at $2.50, and there's no way I could go back and get back in. And the thing about the market is that A&O doesn't care about anyone's feelings or emotions. It doesn't care that you got out at $2.50, or it's going to do what it's going to do, and the chart is going to hopefully give you a lead and indicator to what it's going to do. And so it formed. If we just look at this objectively, the stock's going up, it's in a strong uptrend, the moving averages are up, and it forms a nice base. It pulls back to its 20-day moving average line on tiny volume. It dries up right before the breakout on these two bars. Okay, we look on the 16th of May and the 17th of May, the volume was like, non-existent, not non-existent, but super, super, super low for this stock. And then it wakes up and breaks out. Okay, and it's exactly the same pattern I've shown a few times already today. Yeah, I could show you hundreds and hundreds more, and these patterns just repeat time after time, and it's just a matter of finding them. And the Protrader software will find them for you. And you just need to scan consistently. I think the key is, I scan every day. I spend a lot of time on weekend scanning, but every night I scan too. And so, but you don't have to do that. You could scan once a week, and you're probably going to find most of them. But it's just a matter of being consistent with what you do, whether or not it's once a week or every day. I think consistency is key. And so look, quickly moving on. I think it's time to stop. We just got 1 second. Okay, all right. So we'll just quickly run through a few more. So CIA is a stock that I put up on the Facebook group a few times. I started a thread for it. It's like the chart setup isn't that fabulous. It's not a great patterns or anything. But these were Davis boxes. They came up in the Davis box scan. It's an iron ore stock. Iron ore price has been zooming high, and this stock formed a Davis box. And so that's a key. That's a great buy signal. We had big volume on the start of this Davis box, tiny volume, and then a break up. And the same happened here. Tiny volume down here, and then a break of a Davis box. So this here isn't like an awesome pattern. It's not like a great tight ascending triangle or anything, but there's a Davis box in an iron ore stock with iron ore prices going high, and that's a great signal. Okay, it happened as well in NCM. So the reason, I think the way Davis intended Davis, to use Davis boxes was to find the strongest stocks in the strongest sectors, right? And so I think this is why, this pattern itself isn't anything to write home about. It's only 4 days of consolidation for a breakout. But the fact is that it's a leading gold stock, and the gold price is trending, is breaking new highs. And so we have those two things working together and putting the odds in our favour more. And so that's the only time I'll really trade a really short-term Davis box like this, is when everything is like that's lined up. You have the sector zooming high, and that stock is a leading stock within that sector, within that leading sector. And so you have both those things lined up, and I think that's one of the powers of Davis is when it's used in that fashion. Okay, so look, I've been chatting for over half an hour now. I was trying to keep it under that. So next week I will go through a bunch of other stuff, but a lot of current setups and hopefully explain more. I hope this has been useful to someone out there. And I'll see you next week. All the best. Cheers.